Glen, what is your definition of a hedge fund, and describe the financial tools that contribute to the strategy?
Hedge funds have been around, interestingly enough, for many years. I think there's kind of only been into the traditional domain of most investors' understanding and language in the last few years, and specifically in South Africa. So I think the interesting thing in South Africa is, now that we've moved into this regulated space, I think there's a lot more focus in terms of trying to create product for both retail investors as well as from asset consultants alike. Historically, there was limitations from a regulatory perspective of how much they could invest into hedge funds. That's potentially changed, but now also that it's in a regulated space, I think it's important for asset consultants, IFAs, any type of advisors to actually spend a little bit of time focusing on hedge funds. So it's important for investors and advisors to understand what are the benefits of hedge funds. When one thinks about hedge funds in a traditional sense, what does one get? It's generally about the ability to leverage, so the ability to gear a portfolio and the ability to short. What does that mean practically? Well, it means that one is able to deliver a return, and I think of it more as an absolute return, which means that regardless of the directionality of markets, one is able to achieve positive returns. So in an environment where equity markets, if we think this is an equity portfolio as an example, if equity markets are going up, a hedge fund should underperform because it has this asymmetric profile relative to the market. And depending on how one constructed with the type of risk that one achieves, the type of gearing that one puts into it, you should also be able to achieve things conversely on the downside. So when markets underperform, if you're in a traditional equity portfolio, you might be successful in achieving minus 10% when the market did minus 15%. But is that really what investors are looking for? Investors, in my mind, are always looking for returns on a consistent basis. And I think that's what hedge funds allow you to do. So the ability to use these additional tools of shorting, the additional tools of derivatives, less limitations in terms of the type of environment that you have, the type of regulatory aspects that one has. The universe is obviously a lot more open to use. What are some of the other benefits that you have? Well, I think one of the other major benefits why one uses hedge funds is that traditionally they offer diversification, especially relative to traditional asset classes. So hedge funds offer a low correlation to most other asset classes. And I think that's important in an environment where we are right now. When people are looking for consistent absolute returns, people are looking for levels of capital preservation, hedge funds can play a meaningful part. In my mind, whenever I look at an investment, it's always relative to what is available. So what is your starting point? I have a pool of cash available. So there's an opportunity cost. As soon as I move from cash to any other asset class, there's that opportunity cost of how does it differ. So as soon as you're taking some risk to the table, one needs to be cognizant of that. What hedge funds allow you to do is say, well, in an environment where potentially the outlook for most other asset classes is not as intriguing or enticing as it has been historically, hedge funds potentially can offer that outlet of another investable opportunity. So I think what is important from a Cisco perspective is that now that hedge funds are regulated, one has the ability to go into a retail hedge fund or qualified investor hedge fund. The difference obviously being in terms of both the minimums and the type of oversight and scrutiny that one gets from the regulator. So retail hedge funds are priced on a daily basis. They have much lower minimums and they can be accessed by all types of investors. What it does mean though is that the funds are generally more conservative. The regulation does restrict the amount of leverage that can be used in a portfolio. It does restrict also the type of strategies that one can use. When one looks at qualified investors, those are obviously more the domain of sophisticated investors. Given their high minimums and potentially slightly alternative strategies, we think it's more appropriate for our funds to be qualified investors, and that's sort of the route that we've gone. These funds are non-traditional in the sense that they are quite different to normal hedge funds. So from our perspective, when one thinks about hedge funds from a leverage and a shorting perspective, we don't really use those sort of tools. But what a qualified investor hedge fund has allowed us to do is it allowed us to create what we believe are some of the tools that one has in a hedge fund to deliver those sort of returns. The sophisticated nature of the client base is hopefully a little bit more tuned to understanding what the risks one is exposed to, either from a credit risk perspective, from a derivative structuring perspective, and how one actually gets that in a portfolio. So we believe it is important for our funds to actually be offered more to your investors on a qualified investor basis.
Why should investors consider hedge funds to be included in their investment portfolios?
I think hedge funds are a great investment asset class, potentially been a little bit neglected, especially from a domestic environment. I think when one looks at the characteristic of hedge funds from the benefits that it brings from a diversification perspective, hedge funds typically would offer a lower volatility solution. And I think one needs to look at hedge funds in isolation. Yes, if you look at, and that was your only investment and that's your only allocation that you make, it can be problematic, especially if one doesn't understand the sort of risk that you bring to the table from leverage, from shorting. However, when one constructs it with other asset classes, it's very complementary in terms of the type of risk-adjusted basis that it brings to a portfolio. So relative to other assets, it operates in a different way. It's not as important from a hedge fund perspective to deliver returns from a market directionality. So if you combine it with other assets, I think the sort of allocation that one should make should always be within 5 to 10% of a total portfolio allocation.